Hi. In today's video, we discuss how to trade consolidation breakouts for excellent returns on risk. One of the best and most followed trading strategies is breakout trading. In breakout trading, traders look for a consolidation of price and pull the trigger when the price moves out of the consolidation phase. To make this video easy to understand, let's look at some price consolidations that stocks and other financial instruments often go through. Price consolidations can occur when the stock is trending or when it is in limbo for a long time. When the stock is trending, it generally goes up with high volumes and stalls at some point when the move becomes extended. Traders who bought at lower levels come to book profit, whilst some traders may consider shorting the stock. As a result of this selling, the stock can go down for a few days. Once the selling is over, the stock stabilizes and goes into a state of relative inactivity. Thereafter, another set of traders buys the stock and takes the price towards its previous high. As the stock approaches its previous high, it is met by more selling, but the selling isn't enough to force price back down. The buyers gradually overpower these sellers and the stock takes to new high ground. This is called a consolidation breakout. A consolidation breakout can also happen when a stock pops up with high volume, but due to a change in underlying fundamentals rather than a technical battle between buyers and sellers. In such a scenario, the price quickly reflects the new information. Consolidation can come in several forms, and as a trader, you need to know the most common of these consolidation patterns to trade them effectively and profitably. Let's look at a few common consolidation patterns. We start with the cup and handle pattern. Popularized by the CanSlim developer William O'Neill, the cup with handle pattern is a common and effective chart pattern. As the name suggests, the pattern looks like a cup that looks like a U on the chart, with a small drift towards the right that looks like a handle. The pattern is a bullish continuation pattern and can be formed for a duration ranging from 7 to 65 weeks. The cup should not be too deep, and volumes should be lower than average at the base of the cup, but should increase as the price approaches the high point of the cup as it breaks out from the handle. The handle is generally formed below the previous high, and the price is said to have broken out when it passes and stays above the high of the handle. For example, here is a weekly chart of Apple Inc. from 2021, when it formed a 10-week cup with handle pattern whilst providing an extremely low-risk trade. In this trade, the breakout level was near $153, and the stop loss would have been placed near $147, providing a 4% risk. The reward in this trade would have been in excess of 4 times the risk. For more on this setup, you can check out our videos which provide far more depth. Let's get to the next setup, the flag pattern. A flag pattern resembles a flag on the chart and is formed after a strong rally in the stock. The pattern is quite powerful as it is formed amidst very strong momentum in the price. The pattern lasts for 1 to 6 weeks and is generally followed by a strong move. In the pattern, the price goes up strongly, generally 80 to 100% in 4 to 8 weeks, followed by some profit booking. However, supply is limited and the price does not give much back in consolidation. The consolidation is then followed by a breakout and continuation of the strong uptrend. For example, here is Zoom's chart from 2020. The company became a stock market darling for being the most widely used video conferencing platform during the pandemic. The stock went up almost 90% in 8 weeks and then stalled for 5 weeks within a narrow range. This resembled a flag with a pole. The price then broke out, piercing the upper trend line, and went on to deliver another strong rally. Flag patterns can be powerful but are rare. They may not always offer a low-risk entry point, with stop losses often going beyond 10%. However, given the reward potential in such trades, you should not dismiss a flag pattern just because of the higher risk. You could perhaps adjust the position size, thereby keeping the absolute risk against your account low. After all, trading is all about managing risk against potential reward. The next pattern we have is the symmetrical triangle pattern. This pattern, unsurprisingly, resembles a symmetric triangle, formed when the highs and lows of the pattern are connected through trend lines. This again is a continuation pattern and is an easy-to-spot pattern. In a symmetrical triangle, the price range keeps getting smaller towards the right with lower than average volumes. Champion trader Mark Minervini also applies a similar approach but terms it a volatility contraction pattern. Regardless of terminology, price often breaks out of these patterns with high volume, providing a low-risk pivot. In this example showing the weekly stock chart of Google, we can see price formed a symmetrical triangle with a narrowing price movement towards the right. Here, the entry point was when the price pierced the upper trend line at around the $109 level, and the stop loss would have been placed below the lower trend line at $105, again providing a risk of 4%. The reward to risk in this trade would also have been greater than a multiple of 4. Next on the list, we have an ascending and descending triangle pattern. As the name suggests, these patterns resemble either an ascending triangle or a descending triangle. Again, continuation patterns. The breakout happens when the price breaches the upper trend line, and the stop loss is mostly placed at the lower trend line. In this weekly Tesla chart, there is a clear ascending triangle, where the price met resistance at the same level on the upside, whilst making higher lows on the downside, creating a narrowing triangle pattern. The best entry point would have been the break of the upper trend line at $152, and the stop loss would have been placed below the lower trend line at $135 with an 11% risk on the trade. The stock ended up doing exceptionally well post the breakout, reaching a reward to risk of over 8 times in a very short time. In the same chart, there is a descending triangle pattern as well. Here, the appropriate breakout level was when the price breached the upper trend line at $97, and the stop loss would be placed somewhere below the lower trend line at $90, providing a 7% risk. This trade also ended up achieving a 10 times reward to risk in a short period. There are several other patterns that you can learn about and trade profitably. However, if you are a beginner, I suggest mastering trading 1 or 2 setups rather than diluting your focus on too many setups. As Bruce Lee famously said, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." You would do quite well if you pick one of these setups and practice as many trades as possible to be a master of that one setup. This would be a stress-free and much more systematic approach to learning to trade stocks. One thing you will notice when trading breakout patterns is that they are based on similar principles. A period of consolidation forms the pattern structure. The pattern structure provides the logic for a stop loss, and the stop loss is the foundation for the all-important risk-to-reward ratio. No matter which pattern you trade, if you don't steer too far from this logic, you should do just fine. The pattern I chose to master is the lateral consolidation breakout pattern, hence why we designed scanning software around it. For those interested in the approach, you can access my PDF, the scanner, and join our group of like-minded traders looking to grow our equity curves with limited risk. Just use the links below. As always, thanks for watching.